tonight we are going to discuss about economy for bankers, concept of money supply, right? And inside this session, we will be discussing few points that I will let you know in a second. Yes, we will cover tonight concepts of money supply, monetary aggregates, that is M0, reserve money, M1, M2, M3, M4, L1, L2, L3, liquidity 1, liquidity 2, liquidity 3, new money 1, that is NM1, NM2, NM3. All these concepts we are going to discuss. Also inside we have the discussion regarding fiat money and the commodity money. I have seen a question in RRB 3 4 years back regarding fiat money, so anything could be a question when it is your professional banking exam. Then we have the money multiplier formula in simplest language I will be talking to you, and top MCQs at the end, like every time. Clear? Manpreet Singh says it sounds interesting. Yes, without further delay, let's start. The concept of money supply. Money supply is the total amount of money. Is the total amount of money. Total amount of money in forms of cash, coins, and balances in bank accounts, which is currently in circulation. Money supply is considered a very important microeconomic factor, as it decides the monetary policy of a country and decides the future growth of a country, and also very crucial in terms of GDP growth, etc. And it can check the inflation, which is currently a headache for various central bankers throughout the world. In every economy, it is necessary for the central bank to know the stock of money that they are supplying for the common public to effectively decide the monetary policy or the credit policy of a country. Credit and monetary policy of an economy is all about changing the level of money flowing in the economic system. This is what the central bankers or the monetary policy committee do for us in every bi-monthly monetary policy review, that take place by the monetary policy committee of Reserve Bank of India. Clear? We have a lot to discuss. Please have patience. Yes. So the term of money supply denotes the total quantity of money available to the people of an economy or to the entire public. The supply of money is a stock variable. That means we can say how much the money supply has increased, how much the money supply has decreased. So by open market operations, by repo, reverse repo, change in repo and reverse repo rate, that is the change in the policy rate, the Reserve Bank of India looks into Reserve Bank of India decides the money flow into the system or the credit flow into the banking system. And in a manner or as a result, the inflation is being checked, the recession is being averted, etc. Okay. So yes, uh, the analysis of money supply important for two reasons. It facilitates analysis of monetary developments. Maybe sounds little boring to you, but we have very interesting concept in form of graphics. I will tell you what is M1, M0, etc. So just have patience. Little theory is important for your exam point of view, and little theory is also necessary to effectively answer MCQs, even if you have never come across that particular MCQ throughout your preparation stage. So please have little patience. It is essential for the developments in order to provide a deeper understanding the cause of money growth, why money is growing. It is needed to be known. Okay, and it is essential for monetary policy framework. The money supply in the economy depends upon the decision of the central bank and supply responses of the commercial banking system. Okay, the central bank of all country is empowered to issue currency, and therefore the central bank is the primary source of money supply in any country, be it Federal Reserve in USA or be it Reserve Bank of India in India. Both of them, or respectively in every country, their central bank decides the money flow. They print the money. We will discuss tonight how the money is being printed. Is RBI allowed to print enormous amount of money or not? If they print, what happens? It will lead to the inflation. Okay, so money can only be printed by the central bank. It can be supplied by the central bank. So that currency that is being printed by the Reserve Bank of India is called the fiat money. We'll discuss what is fiat money and its difference with the commodity money in the next slide. The second major source of money supply is the banking system of the country. Clear? So this is the difference between fiat money and commodity money. I will take it to the big screen. Please check the difference between fiat money and commodity money. Fiat money is the government issued currency, that is the 500, 2000 rupees note you see. All that are fiat money. Paper currency, coins, etc. are fiat money. Why they are called fiat money? Because they are backed by a government guarantee or a sovereign guarantee. It is measured as per the face value. Actually, the 2000 rupee note, we treat it as its face value. That 2000 rupees note, if we melt or if you do something with that, we cannot derive intrinsic value of rupees 2000. Okay, right? If you go and buy a silver coin, how they give you the silver coin? The silver coin derives its value from the intrinsic metal it carries, right? So if a silver coin weighs 10 grams, so you have to pay the value of 10 grams silver, right? But if you look into the printing cost of a 2000 rupee note, it will come around 1 rupee or 1.5 rupee, right? I don't have the exact table of what is the printing cost of a 2000 rupee note. Assume that it will cost you rupees 1 or 2 to print that currency. So that means we don't derive the intrinsic value of 2000 rupee note. We only value the face value of that note, whatever mentioned in the face of that instrument, right? So that is the main characteristic of a fiat money. In most modern paper currencies, coins are the example of fiat currency. So government cannot print enormous amount of money. Why? Because it will result in hyperinflation. Clear? It will result in hyperinflation. And commodity money, in the other hand, it derives its value from the intrinsic metal, like gold coins, silver coins, etc. The gold standard is an example of commodity money. If in our ancient ages there are gold coins, right? So these are commodity money, if I can put it in right perspective. Clear? So yes, these two things are important: fiat money or commodity money. And I will have a MCQ on fiat money that is asked in RRB exam 3 4 years back. Okay, while we're discussing this money supply, one of one of our educators reminded us about that. Clear? Yes. So the measurement of money supply, there is virtually a lot of different types of money, especially credit money, and that makes the measurement of money supply is a difficult task. Credit money means the money that is created by the credit system of the banks, in the form of loaning to somebody else. Different countries flow different policies to measure the money supply, just as other countries do their own yardstick to judge the money supply. RBI has its own yardstick to measure, and more or less many central banks measure in that form. So there is little difference. So since 1935, the Reserve Bank of India has been compiling and disseminating the monetary statistics. From 1967 to 68, RBI is used to publish only a single narrow measure of money supply, which is called M1. Then in 67 68, the broader measure of money supply called aggregate monetary resources came into effect. After 1977, following the recommendation of second working group on money supply, the RBI has been publishing the money measures through M1, M2, M3, M4 plus M0 yardstick. So that M0 is reserve money or the base money, and M1, M2, M3, M4 are various types of aggregates of monetary supply. Okay, so these are the details of reserve money. M1 is the most liquid money, and M4 is the M1 is the most liquid. M4 is least liquid. And what is liquidity? The availability of cash in hand. Okay, the instruments that are cash or cash equivalent, or that can be converted into cash without any additional cost. Okay, so now we'll see what is M1. Through graphics, we will try to understand what is M1, M2, M3, M4, M0 for that matter, then the other aspects. Clear? So yes, M1 is nothing but summation of the currency with public plus Demand deposits with the bank. I don't need to tell you what is demand deposit and time deposit. All of you are bankers. I hope that you know the difference between demand deposit means CASA. Anytime it can be withdrawn on the demand of the customer or the depositor is called the demand deposit. Okay. Then the other deposits with RBI. I have told about the other deposits with RBI in the previous edition. You will see what is the other deposits with RBI. Other deposits with RBI means the deposits from foreign central banks, multilateral institution, financial institution, and sundry deposits net of IMF account number one is called the other deposit. Okay, not the CRR SLR we are talking about. We talk about generally. So all these deposits with RBI form monetary M1, right? M1 means money one. Clear? M1 means money one. Yes, commodity money could be. Yes, it is not exactly as derivative one, Manpreet. So M1 is clear to all of you now. If it is asked what is M1, will you be in a position to tell? Will you be in a position to tell? Then I will come to M2, M3, M4, etc. Please confirm whether you got it. What is M1? Currency with public. All the coins, the paper notes I have in my pocket. So is the fellow 130 crore Indians. So all that money with us is currency with public plus all our CASA deposits in banks plus the other deposits other than the deposits of government, deposits of banks in RBI or all other deposits are treated as M1. Yes, narrow money. M1, M2 are narrow money. M2, M3 are called the broader money. Clear? Yes. So why they are called narrow money? Because they are liquid in hand. They are very liquid. M1 is the most liquid type of currency. Okay. So then comes the M2. Here you can see what is M2, deposit of post office savings bank. If you add deposit of post office savings bank, then it will form the M2. How to go to how to derive the M2 with M1? Just add the deposits of post office saving bank. It is M2. Clear? And how to get M3? With M1, you should add time deposits with bank. It will become M3. Time deposit with bank. Time deposit means the FD and RD with bank. You add, it will become M3. And now how to come to M4? M4 is nothing but all deposits with post saving bank. M1 plus M3 plus all deposits with post office, including the savings bank deposit and other term deposits, right? We are not calculating national savings certificate into account when we calculate M4. Clear? Is this diagram enough for you to understand what is M1, M2, M3, M4? Right? M1 is the uh, first 3 points, which is inside the border, currency with public, demand deposit with the bank, other deposits with RBI. M2 plus the savings account deposit in post office, right? M3 all M1 plus the time deposit with the bank FDRD. M4 M1 plus the time deposit with the bank plus all the deposits of post office savings bank. Clear? So then comes the M0. M0 is called the monetary base or the reserve money. What is M0? M0 is currency in circulation plus bankers deposit with RBI, that CRR and the various deposits of banks with the Reserve Bank of India plus other deposits with Reserve Bank of India form the monetary base of a country or the entire money. Okay, all the wealth of all the wealth of Reserve Bank of India. Clear? So it is M0. M0 means the reserve money. Is it clear? Is it clear enough to all of you? Is it clear enough to all of you? So the see, 2 3 questions asked uh, from monetary policy, money supply, etc. So you should understand not MCQs. Here MCQs, I will put forward MCQs for you, but here concepts are going to be important for you because you cannot cover entire economic MCQs for your exam. But the basic concepts you need to cover. Like in first and second chapter of economics, we covered broadly the entire Indian economy and some important economic concepts. Like here, we will be focusing on money supply and things that are related to the circulation of money or currency. Okay. So this is a simple, simplest diagram to understand M0, M1, M2, M3, M4. Clear? Yeah. So now that M0 to M4 is on the basis of the second working group recommendation in the year 1967. Now, sorry, 1977. Now, in the year 1998, there was another committee which recommended another form of monetary aggregate. Like this M1, M2, they stood another way of calculating the monetary aggregates for the economy. On that basis, Reserve Bank of India publishes time to time the monetary aggregates, and we will discuss when and as and when the Reserve Bank of India publishes. Some of them is published in quarterly manner, some weekly, some fortnight basis. So that is important. Maybe they will ask you about these things. So in entire chapter, I will tell you what are important for your exam point of view. M0 to M4, many a times it is asked in banking. So it is an important thing to be know for you to know about M0 to M4. Plus the periodicity of their publication by Reserve Bank of India. Anything that is being published by Reserve Bank of India is important for your exam point of view, or that fiat money kind of thing will be asked to you. So yes, now I will be taking you to the big screen. So maybe this each font size is little low. So yes, you can see over here, following the recommendations of the working group of money in the year 1998, RBI, and who was the chairman at that point of time at 1998? I think our team has forgot to mention YV Reddy. They may ask you the new monetary aggregate which is recommended by the working group of money in the year 1998 was chaired by Mr. YV Reddy, the previous governor of Reserve Bank of India. Clear? I will not leave any stone unturned if it is about your exam. So we will try to cover everything related to it. I don't want you to refer anything other than this set of study materials. Yes. So they have to in the second or in the 1998 committee has recommended us a new norm on monetary aggregates based on the new form of money and liquidity norms. As you know that liquidity is the most important factor for banks to sustain. Otherwise, there will be run on banks. So they have recommended as following: reserve money M0 to be the currency in circulation, bankers deposit with RBI, other deposits with RBI. That should be equal to the net RBI credit to the government, RBI credit to the commercial sector, RBI's claim on banks, RBI's net foreign asset, government's currency liabilities to the public, minus RBI's net non-monetary liabilities. And they told NM1, NM2, NM3 on that basis. NM1 is new money one. NM1 is currency with public. I will be telling it in the new slide. What is NM1? Let's go to discuss because graphics will be easy for you to understand. Maybe theory part is not that important. Yes, NM1 is NM1 is currency with public, demand deposit with bank, other deposits with RBI, right? Similar to M1, no change. NM1 is equal to M1, currency with public, demand deposit with bank, other deposits with RBI. Then let's discuss what is NM2 then. These are new. Manpreet Singh is saying we appreciate your work. Thank you. We have gone through so much of work from last 2 weeks to make this format simplest for our banking friends. Yeah, NM2. NM2 is with NM1, please add short-term time deposits of residents. So here something called resident and non-resident came into effect. Like the money with the bank, or in M1, M2 we saw that the demand deposit with bank or etc. was added, right? Demand deposit, time deposit was added. But what happened? The time deposit could be from FCNR bond and bond from non-resident Indian. And that thing of non-resident, that deposit from non-resident Indian, etc., NRI deposits from NRI, etc., form a part of the balance of payment segment. Okay, so that need not be mentioned or need not be discussed while we are calculating the monetary aggregates of our country. We are discussing the wealth of our economy, so we will be better focusing on the money that is coming from the resident Indians. So any deposit, any time deposit up to 1 year. So anyone making a RD for 11 months or 12 months cannot do. Normally, you do the RD in the in the multiples of 3 months, right? So 9 months, 12 months, etc. Normally, you do nowadays. Banks are allowing you to deposit money in the basis of days, 364 days, no, 91 days, etc., or something like that. Uh, 2 years, 2 year, 3 month, 5 days. But earlier it was in the multiples of 3 months. Okay, so any short term time deposit, FD for 6 months, 9 months, etc., are to be factored when we discuss NM2. NM1 plus time deposit up to 1 year with banks by the resident Indians, and NM3, NM1 plus short term type deposit. That means the entire NM2. NM2 is NM1 plus time deposit up to 1 year. So that means NM3 is NM2 plus long term time deposits of the resident Indians. That means the Indians depositing beyond 1 year, plus call or term funding from financial institutions, the loans, etc., given by the FIs, is called the NM3. Clear? Is it clear? Is it clear? These are either they will ask you M0, M1, M2, M3, M4. M0 remains the same. M1 almost remains same with NM1, but there is a change in NM2 and NM3, and they are not discussing in the new format. They are not discussing the N4. Clear? Because it is realized, later it is realized that the money in post office are not part of the banking system. A separate matter that India wants, the government GOI wants to make the postal similar to a bank, as they have formulated IPB, India Post Payment Bank. But it is realized when the in the year 1998 there was no IPB, or there was no planning to make the post office or convert the post office into a bank. So they realized that the money deposited with the money with the post office are not of the banking system. So they have excluded post office from the new monetary aggregates. Now you can understand, if there is a difference or a question asked basis of the new monetary aggregates, you should not mention anything related to the post office. Am I clear to all of you? Am I clear to all of you? Sunil Singh is asking, in M1, other deposits with RBI by whom? Other deposits, see, there are so many things. I told you what is other deposit with RBI. So here, other deposit means the deposit. First, they have the deposit of Reserve Bank of India is derived into two segments. One is the deposit from the bank and the governments, and second one is the deposit from other sources. Other sources means the deposit from other central bank like the forex reserve, the forex asset, the financial asset from foreign reserve, the the other deposits. I will take you to that slide in a minute. All that will be on your screens. Just a second. Other deposit, here you can see other deposit with Reserve Bank of India is the deposits from the other foreign central banks, multilateral institutions like ADB, IMF, etc., financial institutions from abroad, or any sundry deposit from any other source, that is net of IMF account number one. IMFs, there are two accounts of IMF. The IMF account number one, the money in the IMF account number one is the other deposit of RBI, and the first one is the deposit of banks. The banks make a huge amount of deposit in form of CRR, so that one is being factored here. Okay, NM1, NM2, NM3, we covered it. Clear? So now they have also discussed there is something called liquidity aggregates. We need to cover it by 9 p.m. so that you cannot miss your regular sessions. Yes. So yes, like M1, NM1, NM2, NM3, they discussed about something L1, L2, L3. L1 is nothing but the NM3 plus all deposits with post office savings bank. That is liquid in nature. So that's why it is L1, excluding the national savings certificate. L2 is L1 plus term deposit with term lending institutions and refinancing institutions plus term borrowing by financial institutions by certificate of deposit issued by the FIs. FIs means the financial institutions of the country. Okay, you can find it out in a big screen now. So the L3 is nothing but L2 plus the public deposit of non-banking financial companies. These are the liquidity aggregates. They have not yet asked any questions. We have not seen a question being asked from these liquidity aggregates, but we cannot tell anything. The question making is being changed. New age question makers are being appointed by IBPS, IIBF, etc. So anyone who go through this kind of documents can ask questions from these level of from these segments too. So these are liquidity aggregates. They may ask you how many types of liquidity aggregates: L1, L2, L3, etc. And that is beyond NM1, NM2, NM3. And L1 starts with NM3 plus all deposits with post office savings bank. L2 is L1 plus term deposit with term lending institutes, all certificate of deposit from FIs, and L3 is L2 plus public deposits in non-banking financial company. You know that there are deposit taking NBFCs, all that deposit is factored in L3. Clear? So here are some other points. I will be telling you the important points for all of you, because there are so many things you must not be reading for your exam point of view. Okay. So data, as in look into the third point, data on M0 are published by Reserve Bank of India weekly basis, while those of M1 and M3 are available fortnight basis. Among liquidity aggregates, data on L1 and L2 are published monthly, while L3 is published on a quarterly basis. The working group advised by the quarterly publication of financial sector survey to capture the dynamic linkages between banks and the rest of organized sector. Okay. So as we move from M1 to M4, the liquidity reduces or liquidity is being decreased. So M1 is the most liquid segment of money, most liquid aggregate of money, and the M4 is the least. Clear? In the banking terminology, M1 is called narrow money, and as it is highly liquid, and banks cannot run their lending program without M1. Okay, the money component M3 is called the broad money. Also, if you factor the M4, which is not in use nowadays, but M3 and M4 are broad money, M1, M2 are narrow money. So the RBI required to maintain a reserve equivalent to rupees 200 crore in gold and foreign currency with itself uh, for printing money, and out of which 115 crore should be in gold, and the rest could be in foreign currency. Clear? And this system of printing is called minimum reserve system. And prior to 1956, because in 1956 it is decided that RBI will shift its focus of printing money from PRS, that is proportional reserve system, to minimum reserve system. It is a very important exam question. They often ask you the reserve, what should be the minimum reserve, what should be the new concept of printing currency after 57. It is the MRS, the minimum reserve system India follows. In minimum reserve system, you should have at least 200 crore of reserve to publish money. 200 crore, out of that 200 crore, 115 crore is in the form of gold, and rest could be foreign currency or bullion bonds, etc., gold bonds. Clear? So prior to 1956, there was the proportional reserve system. If bank has to print 1 crore of currency, they should have a minimum 40 lakhs of gold or foreign exchange reserve to print a 1 crore currency notes. So that was called proportional reserve system, and 40% proportionately 40% gold and forex need to be maintained to print money. So you know, as with this slide, in this slide you got to know about, yes, 115 in gold and 85 crore in form of security. Security normally the gold bonds and the forex. Clear? So it is shifted from PRS to MRS, proportional reserve system of to 40% to 200 crores of minimum reserve. Yes, reserve money, that is M0. So the reserve money is the aggregate of RBI's net credit to government, RBI's net credit to the banks, RBI's net credit to the commercial banks, almost both of them same. Commercial bank, apart from commercial banks, there are RRBs, etc. Net forex reserve with RBI, government's currency liabilities to the public, that means money in circulation with the public, and net non-monetary liabilities with RBI. These are six things which is called reserve money or monetary base or M0. Okay. Reserve money is also known as the central bank money, base money, or high powered money. It needs a special mention as it plays a critical role in the determination of the total supply of money. Reserve money determines the level of liquidity and price level in an economy, and therefore its management is crucial. Clear? Yes. So then we will discuss about money multiplier process. It is important. The money multiplier process explains how an increase in the monetary base causes the money supply to increase by multiple amount. For example, suppose that the RBI carries out an OMO, open market operation, uh, the purchase or buying or selling of securities from open market. If they do, or they inject rupees 100 crore, and as a result the money supply in the entire Indian economy is increased by 500 crore, then the money multiplier effect is rupee, rupees multiplier effect is 5 times. Clear? You got the example. What is money multiplier? Money multiplier means if Reserve Bank of India injects 100 crore into the economy, what will happen? Someone will take that money, banks will take that money. Okay. Banks will sell the T-bills, the bills, the sovereign bonds, and bank will get that money from the Reserve Bank of India. They will lend it to others, right? So they will have a minimum reserve system in the form of CRR, etc., and they will lend to others. That other person will create wealth or a fortune out of that money by taking a loan from bank. So similarly, at a result, by injecting 100 crore, I can generate, or the Reserve Bank of India can generate 500 crore of monetary supply in the entire economy. So then the money multiplier is 5 times. What are the step by step process? The bank has rupees 100 of excess reserve, so it loans the rupees 100 to earn an interest. The borrower uses the money to buy something. The seller receives the rupees 100, okay, and deposits with the bank. Assume that the reserve requirement is 10%. 10% means we are taking CRR as 10% here. Reserve Bank, I will deposit rupees 100 with SBI. SBI deposit that 10 rupees of reserve requirement with the bank. So then it is again rupees 90 is left out with the bank. Then the bank again lends that rupees 90 to another borrower. The seller then receives that borrower. Then the borrower who takes rupees 90, he goes to buy some raw material to produce something to carry out his business. Then the seller receives rupees 90 as deposit from the bank, and the bank keeps again rupees 10, 10 percentage of that rupees 90. Okay. Then what is left? Again 81. So this the circulation goes on, goes on, goes on, and finally, if 100 is released from Reserve Bank of India, and it gets multiplied in the hands of the public, it again goes to the bank. Bank gives to public gives it to the bank gives rupees 10 to 10% or 4% of CRR to Reserve Bank of India, and in the rest of the money bank lends it again. So similarly, the money gets multiplied in the hands of banks and or in the hands of the borrower. Okay, so what is the formula of money multiplier? Is 1 by R. R means the reserve ratio. 1 by reserve ratio. They may ask you sometime, because nowadays they are asking tough questions from economy too. Okay, so that means if the reserve ratio is 10%, 1 by R, 1 by 10 percentage is equal to 1 by 10 by 100. That means 100 by 10 is equal to 10. So the multiplier effect is 10. If it is 5 percentage, 1 by 5 percentage or 1 by 0.5 is equal to 20. Calculate. Okay, 1 by 0.5 is 20. Then the money multiplier is 20 times. It based on the reserve requirements, the CRR requirement, because whatever money will be given by Reserve Bank of India to bank, and bank then gives it to the public in forms of loan. Public again comes with a deposit. A portion of that deposit is always to be kept with Reserve Bank of India as per the reserve requirements of our banking system. So we have to calculate 1 by R percentage to decide the money multiplier. Clear? Then similarly there is something called credit multiplier. It is also referred to the deposit multiplier or the deposit expansion multiplier. It describes that the amount of additional money is created by the commercial bank through the process of the process of the lending to the public from the depositor's money. If depositor give you rupees 100, you have CRR SLR requirement, you reserve 10 percentage or currently 18% plus 4%, 17.54 keeps on moving based on the MPC result, right? So 20 rupees 2022 is reserved with RBI or with the bank, and rest goes to the general public again. So that is called the credit multiplier. Okay, formula of credit multiplier: 1 by required reserve ratio. Clear? Required reserve ratio means now we have 17 point, what is the SLR currently? 17.5 or 80, 18 plus 3.5 of CRR. Clear? Yeah. So determinants of money supply, aggregates of money supply is based on the behavior of the central bank, behavior of the public, behavior of the commercial banks. You can get it from the notes. Monetary supply, monetary policy and money supply. Monetary policy, in monetary policy they discuss about OMO, etc., and that checks OMO, open market operation. From open market, Reserve Bank of India does buys and sell the security, then the money supply is being checked. Gist of the session before we go to the MCQs. Gist of the session: money is accepted as payment for goods and services and repayment of debts. It is called legal tender. Commodity money derives its value from intrinsic value of the commodity. Fiduciary money gets accepted due to mutual trust between two parties. Fiat money does not have any intrinsic value, but it derives its value from the government's guarantee. RBI is the sole authority to print currency notes under the RBI Act 1934, which prints the notes denominated from rupees 2 to 10,000. They are allowed, but maximum denomination in circulation is to rupees 2,000. Government of India issues 1 rupee currency under the Coinage Act 2011. Money supply, total amount of money in the economy at any given point of time. RBI measures money supply through these indicators: M0, M1, M3, M4, etc. Okay, so we have some more gist. Liquidity trap, paradox thrift of JM Keynes. Yeah, all that is not necessary. And now time to